Coming up on Market to Market, President Trump attempts to bridge urban and rural interests. With the ink barely dry, work on a new water quality initiative begins. And rebuilding sites and souls in the Lone Star State. Those stories and market analysis with Ted Seifried next.
Really, if we end up...
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, February 2 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. Whether you believe in the concept of Groundhog Day or not, it was deja vu all over again for some sectors of the U.S. economy. The unemployment rate held steady at 4.1% for the fourth month in a row. Higher wages and lower corporate taxes helped push the number of new jobs created to 200,000. Consumer confidence rose more than 2 percentage points on hopes of improved growth throughout 2018. That confidence translated into a 0.4% increase in consumer spending. All these factors motivated the Fed to leave interest rates alone as Janet Yellen presided over her final FOMC meeting. And President Trump rode the wave of positive economic sentiment all the way to Capitol Hill and used the data to ask for a strengthening of a bridge between urban and rural constituents. President Donald J. Trump's first State of the Union lasted 80 minutes, the longest in 18 years, while using roughly 5,200 words. The 45th president laid out a vision in broad strokes. He left out lines about agriculture by name, but did reference deals aimed at boosting existing markets for farmers.
The era of economic surrender is totally over. From now on, we expect trading relationships to be fair and, very importantly, reciprocal. And we will protect American workers and American intellectual property through strong enforcement of our trade rules.
Round 6 of NAFTA negotiations ended just hours before his remarks in the House chamber. Presidential advisors have hinted 2018 will be the year of infrastructure, an attempt to repair aging roads, rails, and bridges.
Tonight, I'm calling on Congress to produce a bill that generates at least $1.5 trillion for the new infrastructure investment that our country so desperately needs. Every federal dollar should be leveraged by partnering with state and local governments and, where appropriate, tapping into private sector investment to permanently fix the infrastructure deficit, and we can do it.
The president called for a streamlined approach to cut red tape. A study from the American Road and Transportation Builders Association reveals nearly 21% of Iowa bridges are structurally deficient, second highest in the country on percentage. The Hawkeye State ranks 7th in numbers of structures, but has the most troubled crossings with 5,067 bridges in need of repair.
We will build gleaming new roads, bridges, highways, railways, and waterways all across our land. And we will do it with American heart, American hands, and American grit.
The president also laid out a 4-pillared plan on immigration, allowing a path to citizenship, securing the border, ending both chain migration and the visa lottery.
It's time to begin moving toward a merit-based immigration system, one that admits people who are skilled, who want to work, who will contribute to our society, and who will love and respect our country.
Last week, a move by the U.S. Supreme Court lifted a stay on the controversial Waters of the U.S. rule. This week, the Trump administration kicked the can down the road and delayed discharge of the measure until 2020. As farmers across the nation breathed a sigh of relief, a state-level voluntary water quality bill received a final stamp of approval. Peter Tubbs reports.
With strokes from 31 ceremonial pens, Iowa Governor Kim Reynolds signed a clean water bill into law this week. The law will make $282 million available over 12 years as part of a cost-share program for landowners and agricultural operations, as well as municipalities, who voluntarily install clean water measures on their property. Also contained in the act is a provision that shields agriculture from being classified as point source pollution. It is Iowa's first clean water bill and comes on the heels of a failed lawsuit by the Des Moines Water Works over the discharge of nitrates into the Des Moines River watershed.
With the science-backed nutrient reduction strategy as our roadmap, we're going to continue to charge forward with our water quality efforts. Together, we have the opportunity to modernize Iowa's agricultural infrastructure, create jobs and entrepreneurship opportunities, promote collaboration between urban and rural communities.
From Market to Market, I'm Peter Tubbs.
According to the National Cotton Council, the cost of production quite often falls below returns. The market has struggled to remain profitable for producers, and even with an increase in the price paid at the point of sale, Mother Nature put a major hold on South Texas profits last year. John Torpy has more in our cover story.
We really wasn't worried about it. We knew we were going to get some rain, but and it started inching closer and closer, and we realized like the day before we better leave farming and get to our house and start putting boards on windows and stuff.
And it finally started turning and inched its way up. It just took hours and hours and hours of 90 to 100 plus mile an hour winds.
The 2017 hurricane season brought round after round of structural and economic heartache to the Gulf Coast states. 3 hurricanes, Harvey, Irma, and Maria, caused an estimated $265 billion in damage from the Caribbean to the Atlantic coast, making last year's hat trick of hurricanes the most expensive in U.S. history. Of all of last year's storms, Harvey gained the most notoriety by delivering an unprecedented 50 inches of rain over 5 days. While epic flooding submerged the city of Houston, farmers and ranchers further south watched helpless as crop losses piled up.
It was as bad as I went through Hurricane Celia in '70, and it took the roof off the house, and we were in it. So I've seen a bad hurricane before, but this was every bit as bad. We did not realize what we would come back to.
We had a little over $200 million in agriculture damage. About half of that was cotton, the other half was livestock.
Hurricane Harvey made landfall right in the middle of the home for 1.2 million head of cattle, 1/4 of the Lone Star State's herd. According to Texas A&M Extension economists, livestock losses climbed to over $90 million. At the Woodsboro Farmers Cooperative, lifelong South Texas farmers gather at what is affectionately referred to as the Table of Knowledge to share thoughts about how life and work have changed since Hurricane Harvey.
We've got 2 tanks that are sucked in. We lost the shed over our front pit to the concrete elevator. We've had a lot of problems getting the grain out because the water had gotten into the tanks and the grain's hard and wet, and we're having a lot of problems doing that.
All the damage brought by Harvey hinders the co-op's ability to serve their member farmers, many of whom logged record harvests in 2017.
6,000 to 7,000 pound milo down here that we've never seen before.
Another record-setting harvest blessed the fabric of many South Texas lives. The cotton harvest was the largest on record, with growers reporting 3 to 4 bale cotton per run. The 2017 crop was setting up to help heal economic wounds dealt to farmers through years of low prices or low yields. Instead, Hurricane Harvey poured salt in those deep wounds.
This year would have really boosted us back and put us back where we needed to be. I mean, we've been having some struggles the last few years getting by, and this would have really got us back on top where we want to be.
They were finally going to make some money. A lot of that cotton was harvested. It was in the bale or the modules. A lot of it was sitting at the gin, and they still lost it. It got underwater in the field, and of course it ruined a lot of the modules sitting at the gin. The tarps blew off, and the cotton blew away.
At the Bayside Richardson Co-op Gin, just outside Bonneview, Texas, workers steadily rebuild. The facility suffered just over $1 million in damages. The value of the cotton lost exceeded $5 million.
We lost all the supporting equipment outside, the overhead seed house, the overhead burr house, warehouse, dust collectors, things that even if I could get the gin running, I didn't have anywhere to go with the seed or anywhere to go with the trash that we remove out of the cotton.
And Harvey's timing looked like it might add insult to injury. The cotton crop was already at the gin, and many producers were worried they might miss out on the financial help provided by their crop insurance.
Normally, crop insurance doesn't cover it if you've got the crop harvested. So that Sonny Berthoud came down, Chairman Conaway came down, we did the tour. So we're working through that, and we think we've got it worked out where crop insurance is going to pick up those losses at the farmers where they didn't get paid for their crop.
As cotton growers continue to rebuild their operations, red tape and the insurance claims process are adding obstacles to a quick return to the field.
Normally, this time of year, they've already had their cotton gin, they've received their checks for their cotton, they've went and paid the bank off, they're working their new operating loan for the year. They're not looking at getting any proceeds from the insurance company on this cotton until March or April of this coming year.
While federal assistance moves at what some farmers think is the same slow crawl as Hurricane Harvey had when it made landfall last summer, officials at the state and local levels are moving at a more rapid pace.
We have a STAR fund to help farmers with things that crop insurance or homeowners insurance that doesn't cover. So we'll come in and pay half their fencing costs if they'll give us a receipt. So we've gone through that. People have been very generous, and Texans are pretty resilient. We bounce back pretty fast. We don't really wait around for the government to come bail us out.
For Market to Market, I'm John Torpy.
Next, the Market to Market Report.
Grain market bulls sunning themselves in the light of contract highs made a move for the clubhouse as South American rains dampened their spirits. For the week, March wheat gained 5 cents, or 6 cents that is, while the nearby corn contract bumped up a nickel. The March soybean contract scraped the $10 mark only to have rain in Argentina, and disappointing experts create a 7-cent loss for the week. March soybean meal followed the trend, falling $4.30 per ton. March cotton shrank $3.18 per hundredweight. Over in the dairy parlor, March Class 3 milk futures gained 14 cents. The livestock sector had a volatile week, including one limit up session. The April live cattle contract moved $1.50 higher. Nearby feeders put on $4.20, and April lean hog contract shed a quarter. The U.S. dollar index stopped the downward spiral but added only 10 ticks. March crude oil hit 4-year highs, even with a loss of 69 cents per barrel. COMEX gold dropped $19.90 per ounce, and the Goldman Sachs commodity index lost nearly 7 points to close at 456.85. Here now to lend us his insight on these and other trends is one of our regular market analysts. That's Ted Seifried. And in case you want to go over things again with Ted, you can download or listen to our market analysis and Market Plus podcasts online anytime, iptv.org/MTOM. Ted Seifried, welcome back to the table.
Thanks for having me, Paul.
All right, Ted. So 3 contracts moved very similarly this week, the top 3 with wheat, corn, and soybeans. Set new contract highs early in the week, and then was it all profit taking from there on, or what else is going on? Let's talk wheat first.
Well, I mean, before we say that, we didn't see any of the contracts set contract highs. We set
highs for the year, I should say.
Highs for the year.
Sorry.
There you go.
Thank you. Thank you.
end of January, early February. So yes, so we did new yearly highs. And I don't think they really all traded very similarly. I think you've got a much different story with corn than you do with soybeans and wheat. To get to wheat, wheat had a parabolic move to the upside based on the crop conditions that we saw for the winter wheat crop being really the worst we've ever seen. With that, I look at the very poor to poor category. That's really the concern, is that there are some probably irreversible losses at this point. Now, that being said, everything in the fair, good, and very good category, especially that fair category, I think has a really good chance, even the poor category has a good chance to come around and make something depending on how weather goes forward. So at the end of the week, you saw wheat kind of pull back a little bit off those highs again. I think a lot of that was technical in nature. We ran right into the 200-day moving average there for both the March and the July wheat, KC wheat. So again, that caused a little bit of a pullback, and we were really quite overbought at that point. But watch 485 in the March KC or July KC wheat. We left a gap there earlier in the week when we shot higher. I think we'll come down and partially fill that gap. If we don't completely fill it, I think there's a chance that we're going to go back towards those highs again. I want to see another test of that 200-day moving average, possibly get up to the 510 area or so.
So you sound like a hold here.
Yeah, no, I'd like
a definite hold.
Listen, we've really put a lot of pressure on wheat because we've been so negative on it, and the global ending stocks are very large. But with the issues that we had with the spring wheat, and now the issues that we're having with the winter wheat, there's going to be quite a bit of premium on protein. And so your better quality wheats, I think there's upside potential there, and I think this winter wheat thing, the strength could stick around if the weather continues to be concerning.
So weather is also kind of the issue in both corn and soybeans, but for different reasons, not in this country. You're looking at a drought in Argentina impacting corn. Is that a fair statement there?
It's impacting corn more so right now than it is soybeans. Right. That's right.
So what do you see when you have, we had a high close, we had reduced acres in that debate. What is moving this market right now?
Okay, so corn for the most part I think is a function of the lower dollar, right? The lower dollar helps in two ways, in very important ways. We've seen exports being really strong for corn in the last few weeks. This week's export sale report, I believe, was a marketing year high at just under 2 million metric tons. That's a very good number. We really needed to see these corn exports pick up, and the fact that we're seeing that is a very good thing, but also suggests that global end users feel like corn is at a fair value between $355 and $360. That's a huge vote of confidence for the corn market and the prices that we're at. Also, when you have the dollar under pressure, you've got large speculators that have been short corn in a time of year that they're usually not very short corn. They're usually flattening out by this time, and they have had a very large short position. So when you have that dollar moving lower, that's inspiring short covering from the funds. So for corn, I think it certainly does have to do with South American weather, Argentina in particular. There's also concern that Brazil, with rain delays, that the longer it takes for them to harvest the first crop of soybeans, the more unlikely that they're going to get in the full boat of the safrinha corn crop. So you might see less corn acres there as well. So just a culmination of things really helping corn out. And corn had some sort of independent strength here this week, especially the tail end of the week when wheat and soybeans were under a pretty significant amount of pressure.
All right, we'll get to soybeans in a moment, but how much over, do you see $4 is possible in corn anytime soon?
Well, for new crop corn.
For new crop corn.
Yes.
I mean, we're close. There.
Yes, 394. Sure. I think it's a good possibility. The thing that worries about me, and we'll get to soybeans as you said in a second, is if you see soybeans come under a significant amount of pressure here in the short term, it's going to be very difficult for corn to continue to follow through to the upside. Plus, if you look at who owns the corn here in the U.S., the amount of corn on farms and the amount of corn ownership in the hands of the producer is just tremendous. So you're going to see a lot of producers selling on each penny or two we go higher.
Okay.
That could be fairly limiting.
All right, so we need to answer some questions from our viewers, both Instagram, Twitter, and Facebook. And this one, Ted, comes from Matthew in Napoleon, Ohio, and he wrote us on our Facebook page. And he's asking, where does the U.S. national yield for soybeans have to be for the market to become worrisome about supply, assuming 91 million or more acres?
Okay. Well, it depends on how much more, but let's call it 91 million acres in soybeans. A lot of that depends on where we end up as far as ending stocks are concerned. I'm a little worried that we're going to see ending stocks quite a bit higher than what the USDA is currently projecting. There's been many years where the USDA started out with a very high number in the ending stocks and we end up with a much lower number. I don't know if this is one of those years. So that being said, I'm going to assume a 500 million bushel carryover in soybeans. If that's the case, we probably need to see soybean yield 47 or below to really have a shot at much stronger prices than what we have now. I'm worried about demand going forward. And this year's crop in soybeans, seems to be a little bit problematic. There are some quality concerns there, and I think that's being reflected in our exports.
There was a story about that last week about protein. Is that what you mean?
That's exactly what I mean. I've been talking about this for a couple weeks now. Our oil yield is 3% off of September. September was the last month we predominantly crushed old crop soybeans. So our oil yield is down significantly from last year. Protein content is down significantly from last year. So what that means is that when we, or global end users, go to crush soybeans, our crush margins are much tighter. Crush margins are already very tight in China. So China has really shied away from wanting to import our soybeans in favor of a more quality product down in South America. You saw that this week with our export sales in soybeans, really underwhelming the trade expectations,
right.
But meal sales were really good. The world is saying we want the product, we don't want the soybean. That's a problem because our crushing capacity isn't big enough to offset the deficit that we might end up with exports.
All right, real quick before we move on, time to make sales, time to hold. What's your recommendation?
I'm fairly aggressive on soybeans right now. I'm
okay.
worried that exports are going to add another 50 to 60 million bushel back on the balance sheet.
Yeah.
For corn and wheat, I think you can hold. You had to make some sales in wheat this week, but for now I think you hold.
Okay.
Corn a little bit here and there, just in case soybeans go down, but I think you do hold for the most part for corn.
We're going to play rapid fire in livestock here.
Go.
Let's start with the cattle.
Yeah.
The inventory report, we saw some bears show up. Is that fair to say?
Or
do you interpret it differently? Because there was different interpretations of that report.
The inventory report I thought was actually fairly friendly. It doesn't show the expansion as quickly as what we were thinking, especially when you compare it to the cattle on feed report that you saw the previous Friday. I'm fairly friendly cattle at this point. The hiccup to that right now is the drought in the plains, so we might have cattle being pushed to market sooner than normal, so there might be an upfront sort of supply glut. But exports have been really good. Domestic demand has been really good. Packers margins are good. I think there's room for upside on the cash side of things, so I'm still fairly friendly for cattle and feeder cattle.
All right. Okay, feeders, a little more there. Again, another one of those limit up contracts yesterday.
Yeah.
What was driving that?
Well, partially the inventories report,
okay.
And then also follow that up with exports. So you put those two things together, and there's your fundamental reasoning. Technically, we had held key support there after we failed the resistance the day before, backed off a little bit, got some good positive news, fundamental news, and then technically we were able to break those highs and then follow through on that. So it looks good. You know, Team 150 feeders, we finally got that in play, right? And I think there's more upside potential from there. I'm currently targeting 154.
Do you see more feeders coming out of fields into lots anytime soon?
Yeah, so that's the question that we have. And, you know, we've got a lot of lighter animals on feed right now, and a lot of that has to do with the drought that we've got going on. So overall, I think the nature of that is supportive for feeder cattle. And so, yeah, with the lighter weights, it is possible.
All right. Fundamental news was in the hog market this week. There was a story about, hey, everybody loves U.S. pork. It's a cheap buy right now, specifically in China. But the question becomes, though, what happens if there's a change with NAFTA or China, and is that playing in the market right now? What's your take?
Well, trade relations are always something that the market's, you know, watching, but we don't trade anything. We've been kind of sort of fooled by it a few times before. We're not going to trade anything until it actually happens. In the meantime, the lower dollar has been giving us really very good pork exports, so that has been supportive. However, futures are trading at a pretty significant premium to cash, and you look at weights being up 2 pounds or so last week compared to this time of year we expect to see sharp declines. I'm worried that the big supply that we have up front eventually is going to weigh on the market and at the very least take away that premium to cash.
All right. Before I let you go, crude oil retreated a little bit. Is this retracement or is this the beginning of a trend?
Well, you know, I'm not sure if we have a blow-off top, but a reversal lower week is not a good thing for crude. When you get above $60 a barrel, you really bring on a lot of production here in the States, which could be offset a bit by the lower dollar. But I'm worried that OPEC starts to fall apart with these better crude prices. So longer term, I'm bearish, but I don't know if it's the top right here.
All right, Ted Seifried, thank you so very much. Appreciate the time.
Pleasure's mine.
That will do it for the broadcast version of this program we call Market to Market. However, Ted and I will keep the conversation going, including answering more of your questions during Market Plus, which is available in podcast and video form on our website. You know, you want to help set a record? You could be the 500th subscriber to our YouTube channel. Tell everyone you've clicked subscribe at youtube.com/market to market. And join us again next week when we'll examine how urban consumers are getting fresh produce from a different kind of container. So until then, thanks for watching. I'm Paul Yeager. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.